Hi, this is George. In this video, we are going to see the basics of options. So let's take an example of SBI share. Say suppose you are confident that SBI share is going to go in the upside in the month of Jan, and by Jan and it will be trading more than 500. If you feel so, maybe you would have done a fundamental analysis or technical analysis, or you are expecting the quarterly results to be on a good side, or if there is an RBI policy and because of that the stock price is about to increase. In any of these instances, if you feel that you have conviction that the share price is going to go above 500 or something, it is going on the upside, then you are planning to buy a equity share of SBI. Say suppose the capital you have in hand is only 6,000. With 6,000 you can buy around 130 shares. And as you expected, by 27th of January, the price was quoting as 529. So the profit you got per share is 529 minus 466, which is 63. And as you have 130 shares, your total profit is around 8,200. Say suppose similar for the same thing, instead of buying equity, if suppose you have bought a call option of 500 strike price, let's see, this is as I explained in the last video, I'm using the option application. This I have given SBA as the instrument here, and third is the start date, and 27 is the expiry and payoff date. And as I told before, like call last traded price and put last traded price is the only thing that we need to see, and strike price. We can ignore the rest of the fields. So 500 call option price is trading at 3.9 on Jan 3rd, and by 27th Jan, which is the last Thursday of the month, around 320, the price was at 28.5. So from 3.9, it has become 28.5, which is almost 7 times. So lot size for SBI is 1,500. It differs for each stocks and index. So now for like say four, we'll consider this as 4 rupees, 4 into 1,500. You would have invested 6,000 and it has become around 42,000. So your profit is 36,000. For the same thing, if suppose if you have bought equity, your profit only was 8,200, but for call option, you would have got profit of 36,000. And this is the reason people go to options, because if you're so convicted that it is going to go in the direction that you predicted, instead of buying a stock, you can buy options so that you can multiply your returns. But if your view goes wrong, that is totally different story. You will be end up losing a lot, but you won't lose much if you bought a equity share. Let's go to the terminologies. So you can consider the options as something like betting. So now you have paid like 4 rupees upfront, considering that it is going to go up. If suppose it has not went up, then you would have been losing all the 4 rupees. As because it has went to 529, you have ended up with 28.5. If suppose it has ended at 510, then it would have been ended at 10 rupees. These are called as premium. The price that you give for buying and selling, it is called in options terminology as premium. And strike price is something as like in this 500 call option, 500 is the strike price. There will be like in this example, SBI is having strike price in the multiples of 5, 505, 510, 515. Few things here it is missing like 575, 585, 595. That is because of there won't be much open interest in those. We can talk about open interest in some other video, but for now you can see like in multiples of 5 there are strike prices available. That is called a strike price. And lot size for SBI is 1,500. I have told previously, like for Nifty it is 50 and Bank Nifty it is 25. So what is a lot size? You have like say 100 rupees or 1,000 rupees. You cannot say like I will buy as it is only 4 rupees, I can buy instead of 1,500 I'll buy say 20 quantities or 50 quantities. It doesn't work that way. You have to buy a lot. Say suppose if you are thirsty and if you want to buy a Sprite bottle, which is a 2-liter bottle, which is priced at 100 rupees, you cannot say like I'll just have 2 sips for 10 rupees and I don't want to buy the entire bottle. You cannot say that. Similarly, if you want to buy one option, call option or put option in SBI, you have to buy in lot whatever it is. For SBI it is 1,500. It differs for each stock and index. And call option, as I told, if you are predicting that market is going to go up, you will buy a call option. And if you predict market is going to go down, you will buy put option. Or you can sell call option if you think market is going to go down, and you can sell put option if you think market is going to go up. Underlying is something with which the option contracts move. For in this case, 500 call option of SBI moves in contrast to what SBI is. It is like directly proportional to how the stock price of SBI moves. So that is called underlying expiries. For each of the stocks there will be like monthly expiries. Any stock you can say SBI or Axis Bank or whatever the stock name that you know, that will have for a month only one expiries will be there. But for indexes like Nifty and Bank Nifty, there are four or five, like weekly there will be expiries. Say suppose there are 4 weeks in a month, then all the weeks will have one expiry. Every Thursday of every week is considered as expiry, and for monthly the last Thursday is considered as a expiry week, expiry day for the stocks. Say suppose the Thursday is a holiday for NSE, there is no trading, then Wednesday is the expiry in those circumstances. And coming to probability, the probability definition is number of favorable outcome by total number of outcome. Say in general a stock can move 100 rupees in the upside or downside. So for SBI, which was trading at 466 in the starting of January, it can go somewhere between 366 to 566. So total possibility is 201 including 466. Out of this, you will be profitable only when the stock moves between 500 and 500 and 566, not above 500, because you have also paid 4 rupees for that. So after 504 only if it becomes 505, you will be getting 1 rupees 1 rupee profit, 1 into 1500 rupees profit. So till then you will be in loss. So between 505 and 566 is the you will be in profit. So the total number of outcome for that is 61 out of 201. So probability is only 30% of winning. So if you are an option buyer in this contract, you will be profitable. The profitability is only 30%. But if you are a seller, then you have probability of 70%, and that is the reason I always tell to be on the seller side. But if the probability is more in selling, why can't everybody be in the side of selling? Actually, for selling, you need more margin money. Let me can take you to another site. The Zerodha margin calculator gives you the margin values. So say suppose let's consider options, call options of Nifty. Nifty is trading around 16,900 or 18,800 as on today. We'll just consider 17,000 call option we are selling. So the margin required for this is around 1 lakh, more than 1 lakh actually. So if suppose the 17,000 option price is trading is like 10 rupees, then 10 into 50 only with 500 rupees you can buy one lot. But for selling one lot you need 1 lakh margin, which is very big. So that is the reason people, not everybody comes to selling side, because the margin money is needed is so much more. Now for that again we have a concept called pledging. If you see in my previous videos I would have told like don't go in buying a stock in either fundamental analysis or technical analysis, but you can just buy the top 50 stocks of Nifty, the renowned stock, the stocks that you know. Why? Because these stocks can be pledged for margin. The top stocks can, they say haircut. So for the top stock they'll take only 10% haircut. See suppose if you're investing 1 lakh rupee in SBI stock, you will be getting a, if you are pledging that, you'll be getting a margin of 90,000. So with that 90,000, and if you add more 10 or 15,000, you can sell one lot of Nifty. But so that is the reason I'm asking you to buy a quality stock where haircut will be minimum. Say suppose if you have invested in some Nifty like a mid cap or small cap or any penny stocks, the margin will be very, the haircut will be like only 60% or 70%, or even in some penny cases they won't even give any margin money. So in those cases you cannot do pledging on that, and you cannot do selling. So it is not only limited to stocks. This pledging can be done on even gold or FDs by some brokers, and ETFs like Nifty Bs and Bank Nifty Bs. So instead of buying a physical gold, like some good new auspicious days coming, let me go and buy some gold. Instead of that, if you can buy a gold B or sovereign gold bond in stock market only, then you can pledge those and you can get margin money. And with that margin money, you can start selling options. So in this way, you can, it will be like double benefit for you. Your gold price is also going to go up, and if you are able to make profit out of selling the option, that is also going to be a benefit for you. So it will be a double benefit, and that is the only reason I'm asking you to buy like quality shares. Now hedging. Hedging, if you see, like I have mentioned here, like for every one sell, you have one buy. So for this example, let us say you have already sold 17,000 call option. Now if you're buying 17,100 call option of Nifty, your margin has reduced from 1,07,000 to 22,000. So your margin benefit is 85,000. There it has drastically declined. The reason is because if you are selling only one lot of Nifty, as I've told before, like if you are a seller, the risk is more and you have unlimited loss. But if you buy something to protect that loss, that is called hedging. Here in this case, your loss will be capped somewhere. It will be like it won't go beyond some level. So in those cases, the broker will be okay to give you margin benefit. And in this case, as you see, like from 1 lakh, it has come down to 22,000. So that is the reason I will always recommend people to have hedged position. It might not be like for every one sell you need to have one buy. Even if you have sold one call option, if you sell one put option, that is also called as hedging. So these are like whatever strategy that you deploy. With that strategy, if you are not going to have a drastic decline, no matter what happens in the stock market, that is called hedging. You can see so many people call like a professional hedging strategist or he's a hedge fund manager, something like that. So those are all because of these the strategies they implement basis of hedging. Now, moneyness of contract I have told in the previous video, like ATM, ITM, OTM, that is at the money, in the money, and out of the money. In the case of SBI, the stock price was trading by Jan 3rd as 466. So nearest to 466 in multiples of is 465. That strike is called as at the money strike. And ITM and OTM, ITM is like if suppose intrinsic value of the contract is more than one, then that is called as in the money. And if the intrinsic value is zero, then it is called OTM. I'll tell you what is intrinsic value. Say suppose let's go just see the last part of this slide in the example. I've given 465 premium like a call option of 465. So if you see the January 465 call option price was 13.35. So this 13.35 is the premium. This premium is calculated from this formula intrinsic value plus others will have time decay delta gamma vega. Time decay is called as theta. Actually you won't find this definition anywhere. This is something I just gave for ease, for the ease of understanding. So what you need to understand here is like the intrinsic value plus others will be the premium. Here intrinsic value is spot price minus strike price. Spot price was 466 and strike price is 465. So 466 minus 465, which is 1. 1 plus others. In this others, time decay will be the major chunk. So now the suppose on Jan 27, if market had ended as 466 only, then your stock, this 465 call option would have ended as 1 rupees from 13.35. This 12.35 would have eroded and decayed and it would have become zero. As I have told in the previous videos, Thanos snap, all these things because of time decay, this would have become zero. So uh, that is what I'm trying to say here. In ITM option, if you say here 450 means the spot price is 466 minus strike price is 450. So 16 plus 5.85 is the others. Here it is intrinsic value is more than one, more than it's a positive number, so it is considered as ITM. And OTM in case say suppose it is 480, only others will be there. So in those cases are called as out of the money. In this, if you see, the ATM will have higher time decay or the others value will be more for ATM. It will be comparatively more for OTM in compared to ITM. Let me just order it. ITM will have the lowest time decay. Next come OTM, then finally ATM. So say option sellers usually will be like they'll be selling ATM or OTM contracts than ITM because these contracts will have more time decay and the probability of you getting profitably more as these will become zero easily than the ITM. And even if it becomes zero also, you will not get major money out of the ITM contract. So generally, option sellers will trade in ATM and OTM options. So maybe in this, similarly for put options also, you can calculate these in your leisure time. So now maybe this video will have so many terminologies and so many concepts which might be like difficult to grasp in first time. What I'll say is like with this information you can start have a look at the stock market, how it goes. In the meanwhile you can do some paper trading or virtual trading. There are many websites, there are many portals that allows you to do virtual trade, or even you can with just a pen and paper you can do it by yourself, just to have a watch over market. And from next video we're going to start with the strategies on selling the uh, options. So once you are familiar with that and once you are gain little confidence, then you can slowly start into getting into stock market, maybe in a month or so. I won't say that you have to rush and just jump into it and start trading from day one. Just take some time and learn few concepts before entering into stock market. And once you know the basics, then definitely you can enter and you can start making money. And as I said before, we'll from next video we'll start about the strategies. Thank you.